Hey there, Iggy the Investing Iguana here. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with a total of 460,000 reads. Are you ready to discover the REIT that's got analysts buzzing? In this video, I'll dive deep into ESR-LOGOS REIT, or ELOG for short, and reveal why it's become the darling of the investment world. If you're looking to supercharge your portfolio with a top-performing REIT, you won't want to miss this. So, grab a snack, get comfortable, and let's explore what makes ELOG so special. Let's start with the basics. A REIT, or real estate investment trust, is a type of company that owns and manages income-generating real estate. This could include a variety of property types, such as residential buildings, commercial spaces, hospitals, or even warehouses. The primary goal of a REIT is to generate a steady income stream for its investors. When you invest in a REIT, you're essentially buying a piece of the properties that the REIT owns. In other words, you become a part owner of these properties. This allows you to earn a share of the income generated from the rent collected from these properties. It's an exciting way to get involved in the real estate market without the need to buy or manage properties yourself. Now, let's talk about ELOG. Despite the turbulence in the market, ELOG has managed to stay relatively stable. The broader S-REIT sector, which includes all REITs listed in Singapore, has seen a decline of approximately 14% in their unit price year-to-date. However, ELOG has proven to be more resilient, with its unit price only dropping by 9%. This is akin to being the child on the playground who manages to escape with just a minor scrape while everyone else ends up with bruises. It's a testament to ELOG's robust management strategy and the quality of its property portfolio. Despite the challenges, ELOG continues to provide a steady return for its investors. It's a shining example of the potential benefits of investing in REITs. Market analysts have been closely observing ELOG's performance, and one of the key factors that has caught their attention is the REIT's strong rent reversions. In the world of real estate, rent reversion refers to the process where the rents are adjusted, usually upwards, when the leases are renewed. This is a positive indicator for ELOG, as it implies that they are able to command higher rents for their properties, reflecting the high demand for industrial properties in Singapore. This demand could be driven by various factors such as the strategic location of the properties, the quality of the facilities, or even the overall growth of the industrial sector in Singapore. It's a testament to ELOG's strategic property acquisition and management that they are able to capitalize on this demand and translate it into higher rental income. However, it's also important to note that ELOG's occupancy rates have seen a slight decrease. Occupancy rate is a measure of the utilized or rented space as a percentage of the total available space. A dip in this rate could suggest that some industries are reducing their space requirements, possibly due to factors like industry-wide downsizing, cost-cutting measures, or a shift towards more flexible work arrangements. While this might seem concerning, it's crucial to understand that fluctuations in occupancy rates are quite common in the real estate industry and can be influenced by a variety of market conditions. It's also possible that this dip is temporary and the occupancy rates could bounce back as ELOG adjusts its strategies to align with the changing market dynamics. ELOG has been actively engaged in a strategic process of divesting some of its non-core assets. This means that they have been selling off properties that are not central to their primary business operations or long-term strategy. While this might seem counterintuitive, it's actually a common practice among REITs and other investment entities. This strategy, however, does have an immediate impact on ELOG's net property income. The sale of these assets results in a temporary decrease in the income generated from property rentals. But it's important to understand that this is a short-term effect. The goal here is long-term optimization of the portfolio. The analogy of cleaning out your closet is quite apt in this context. Just as you would remove clothes that you no longer wear or need, ELOG is getting rid of properties that no longer fit into their strategic plan. This process frees up resources and creates room for new investments that are more aligned with the REIT's objectives. By doing so, ELOG is essentially making space for new, better-suited properties that can potentially generate higher returns. It's a strategic move aimed at enhancing the overall performance and value of the REIT in the long run. So, while there might be a short-term dip in income, the expectation is that this move will lead to greater profitability and growth in the future. It's a clear example of the saying, short-term pain for long-term gain. Looking into the future, market analysts have identified several potential catalysts that could positively impact ELOG's unit price. One such catalyst is the continuation of share buybacks. This is a process where ELOG purchases its own shares from the marketplace. The effect of this is a reduction in the number of outstanding shares, which can increase the value of the remaining shares and potentially boost the unit price. Another potential catalyst is acquisitions that could increase the REIT's distribution per unit. This refers to ELOG acquiring new properties that generate additional rental income. This increased income can then be distributed to the unit holders, effectively increasing the return on their investment. Lastly, the sale of assets that enhance its net asset value could also serve as a catalyst. When ELOG sells off properties at a profit, it increases the overall value of the REIT. This increase in net asset value can make the REIT more attractive to investors, potentially driving up the unit price. Certainly, like any investment, there are challenges that ELOG faces. One of the key challenges is the impact of rising interest rates. When interest rates rise, the cost of borrowing money increases. This is because interest is the cost paid to lenders for the privilege of borrowing their money. For ELOG, this means they're paying more to finance their real estate investments. However, ELOG has been proactive in addressing this challenge. They have secured a sustainability-linked loan facility. This is a type of loan where the interest rate is linked to the borrower's performance on certain sustainability metrics. It's a way for ELOG to potentially lower its borrowing costs while also demonstrating its commitment to sustainable practices. In addition to this, ELOG has also renewed its interest rate hedges. Hedging is a strategy used to offset the risk of adverse price movements. In this case, interest rate hedges are used to protect against the risk of rising interest rates. By renewing these hedges, ELOG is taking steps to manage its exposure to interest rate fluctuations. The analogy of refinancing a home loan to get a better deal is quite fitting here. Just as a homeowner might refinance their mortgage to take advantage of lower interest rates, ELOG is using strategies like sustainability-linked loans and interest rate hedges to manage its borrowing costs. It's a smart approach that shows ELOG's commitment to managing its financial health while also navigating the challenges of the market. It's a testament to the strategic thinking that goes into managing a successful REIT. Indeed, despite the challenges, there is a sense of optimism about ELOG's future among many market analysts. They highlight the REIT's attractive distribution yield as a key factor. The distribution yield is a financial ratio that shows how much a company pays out in dividends each year relative to its unit price. For ELOG, this yield is projected to be over 8% for the upcoming fiscal year. This is a significant return, especially in the current economic environment where interest rates are low. It means that for every dollar invested in ELOG, investors can expect to receive over 8 cents back in dividends. This high yield can make ELOG an attractive investment option for those seeking regular income. The analogy of finding a shiny quarter on the sidewalk is quite fitting. In a world where low interest rates mean that savings and fixed income investments yield little return, a REIT like ELOG offering a distribution yield of over 8% is indeed a valuable find. It's like stumbling upon a shiny quarter amidst a pile of pennies. It's these kinds of opportunities that can make investing in REITs a potentially rewarding venture. And there you have it, folks, the inside scoop on why ESR-LOGOS REIT is analysts' top pick. ELOG's impressive rent reversions, strategic portfolio optimization, and potential growth catalysts make it a standout in the REIT market. As always, remember to do your own research and consider your unique financial goals before making any investment decisions. If you found this video helpful, give it a like and subscribe to the Investing Iguana channel for more insights to help you navigate the wild world of investing. Until next time, this is Iggy, reminding you that with the right knowledge and a bit of Iguana intuition, you can achieve your vision of financial freedom. See you in the next video.